Thank you for sitting down with me again. I've been reflecting on everything we discussed in the last video about reinsurance, and it really opened my eyes to how important reinsurance is for insurance companies. But I feel like we've only scratched the surface. I've been wondering, what motivates reinsurers to take on these risks? What's in it for them?
That's a great question. I'm glad you're eager to dig deeper, because this is an essential part of understanding the reinsurance ecosystem. In our last video, we focused on how reinsurance helps insurance companies manage their risks and ensure their financial stability. But you're right, there's a whole other side to this, and it's about how reinsurers benefit from these agreements.
Exactly. I understand why insurers need reinsurance, but it feels like there's more to learn about why reinsurers are so willing to take on these risks. Surely they aren't just doing it out of goodwill.
You're absolutely right. Reinsurers aren't charities, they're businesses, and like any business, they aim to make a profit while managing their own risk. In fact, reinsurance is a key part of the financial and strategic planning for reinsurers. In today's video, we'll explore why reinsurers get involved in these arrangements, what they gain, and how it fits into their overall strategy.
That makes sense. So, where do we start?
Let's start with one of the most significant advantages for reinsurers, diversification. Reinsurers operate on a global scale, working with multiple insurers in different regions and sectors. This means they're not dependent on any one market or type of risk. For example, a reinsurer might have contracts with insurers in North America for natural disasters, in Europe for liability insurance, and in Asia for health risks. By spreading their exposure across multiple lines of business and geographical areas, they're able to balance profitability with risk management.
So, reinsurers are not just taking on risks from one insurer or one type of policy, but from many insurers in different parts of the world?
Exactly. That's the beauty of it. By diversifying their portfolio, they reduce the likelihood that one single event, like a major hurricane or a financial downturn, will significantly impact their overall financial health. If one area suffers heavy losses, they can offset that with gains in other areas. In this way, reinsurers create a more stable and predictable business model.
That's really interesting. It sounds like diversification helps reinsurers manage their risks in a very strategic way. But what about profitability? How do they make money from these agreements?
Great question. Reinsurers earn a share of the premiums paid by the primary insurers. When an insurance company buys reinsurance, they essentially pay the reinsurer a portion of the premium they collect from their policyholders. In return, the reinsurer takes on a portion of the risks associated with those policies. So, while the reinsurer is sharing in the risk, they're also sharing in the rewards.
So, reinsurers can still profit from the premiums, as long as the claims don't exceed what they've calculated?
Exactly. Reinsurers are experts at managing large-scale risks, and they use sophisticated models to predict the likelihood of claims, just like primary insurers do. By balancing the risk across different regions, industries, and even types of coverage, they can make sure their risk exposure stays within manageable limits. When done correctly, this allows them to remain profitable over the long term, even in the face of catastrophic events.